I'm Neil Stothard, Chief Executive, and joined by
Alison Bainbridge, the Group Finance Director.
Thank you for joining us today, and we'd like to take the opportunity to take you through the highlights, the market and trading review, which I shall do, and then Alison will finish with the financial review at the end. So, in terms of highlights, we're very pleased with the material growth in profits that were reported, up 67% on prior year. The prior year obviously was COVID impacted, but nevertheless, we're very pleased with that recovery. I think one of the most important numbers in these results is the fact that our quality of earnings, which we measure by return on capital employed, got back to pre-COVID levels at 14.5%. Which is something which we think is a very good result. I will talk to markets in more detail shortly, but in summary, infrastructure strength came from HS2 and transmission work. And in contrast, we saw slower activity in AMP7 and rail, though it did improve towards the end of the financial year. In general construction, which is our other very large market area, experience was mixed there as well. We had strong demand from repair and maintenance activity, but new build was weaker. House building held up well throughout the year, and the international division, which is a lot smaller than the UK division, did see a steady profit recovery. Capital investments at 49% on prior year, with an emphasis on lower emission solutions to customers. And we've had significant progress on ESG implementation across the group and digital innovation as well. The final highlight would be that we had two acquisitions in the year. In November, December, we bought M&S Hire, which is supporting the commercial fit-out market. And we, right at the end of the financial year, we entered an agreement with Watkin Jones to acquire their plant and tools assets and to sit alongside a 5-year partnering agreement to supply them with their hire requirements. In terms of headlines, Alison will talk to these in more detail shortly, but revenues were up 14% to 351 million. I mentioned the 67% increase in profits and the return on average capital employed at 14.5%. Net debt did increase by 8.7 million, which Alison will talk us through, but that's after the £60 million investment in fleet. In terms of the restoration of long-term growth, this revenue slide shows that we are not quite back to where we were pre-COVID, but we've made significant progress and are well on track for that. I think the final element of the gap from our point of view is that certain of our core markets have lagged the recovery. I will talk to those shortly. And the graph for profits, which is the next slide, shows a similar trend. Material dip in the COVID year. We're not quite back to where we were. We've still got a bit to go there. But nevertheless, that's an excellent result and saw double-digit margins return in the year. So, in terms of the core markets that we support, those of you that have followed VP before know that we talk specifically to 4 core market areas of infrastructure, construction, house building, and energy. What we've got here is the split in terms of the total exposure. The infrastructure market grew by 12% in the year for us in terms of our revenue experience. And the highlights were that we saw a positive demand from the HS2 project. We also saw good demand from transmission areas as well. By contrast, after the second year of the AMP7 programme, which was started in April last year, was actually a lot slower to get started than we expected. So we had a subdued demand from AMP compared with what we might have reasonably expected, particularly towards the end of the second year. And as we enter the third year, we are finally starting to see activity coming through, which is positive. And the rail market was also slower. It held up well during the main COVID pandemic year of 2020, but it didn't really move forward again as we might have reasonably expected. In terms of construction, as I said at the start, another mix of experiences with RMI, the repair and maintenance work that we're involved in, being very supportive to our activity and creating good demand. And that's largely driven the growth year on year. But new build has been slower. And by new build in particular, we're talking about private commercial and non-residential. And this is the likes of offices, leisure, and also in the public terms, hospitals and schools. So I've got some macro graphs to look at on the next slide, which will, I think, support the experience that we have seen as a business. So that's construction. In house building, relatively modest year-on-year growth of 4%. But we have to remember that house building was probably the market that of our core markets that recovered the most quickly post-pandemic. And this sector has been extremely supported throughout the last 12 months and continues to do so. So house building definitely been a positive for us in these numbers. Energy market, 26% year-on-year growth looks quite substantial, which it is. We've seen pickup in our oil and gas business in terms of well testing activity as oil and gas prices have increased. But the main reason for the increase in year on year is that we were involved in a major industrial shutdown at the beginning of the financial year, which has given the energy line a significant boost. Other includes outdoor events, which again is an area that has been relatively subdued until this year. Ground investigation, aviation, defence, mining and medical, amongst many others. So in terms of the macro look, these graphs that I've produced are based on the Experian UK construction forecasts in spring 22. They're just one organisation's view of the future and also indeed the past. But what these graphs are meant to do is to try and give you an illustration of which markets are recovering and which have not. So in the top lines, we've got new infrastructure and new housing. Infrastructure has dipped. It didn't dip that much, actually, during the pandemic. It recovered strongly last year, and the prospects going forward look pretty positive for infrastructure. New housing, again, dramatic drop-off, particularly in April, May 20, but a rapid recovery as well, and an extrapolated growth for that segment. And then in the bottom right-hand quadrant, total repair and maintenance, similar sharp recovery in 2021, with further substantive recovery anticipated, or in fact, not recovery, further anticipated growth in RMI going forward. Some of the RMI work would be repurposing of buildings as well as just general maintenance. So we have seen, I think, some transfer away from new build into refurb, and that's certainly a factor which we're aware of. The bottom left-hand quadrant's the one I really wanted to pick up, which is This is new non-residential, which is public non-residential, private industrial and private commercial. Post-Brexit decision, the construction market started to weaken. And as the graph shows, when the pandemic hit, it weakened even more quickly. And what the graph illustrates is that these markets, and I think they estimate it's about 20% of the total construction market is defined as new non-residential. That was flat in 2021, and there's a modest recovery anticipated, but that recovery is not back to the levels that we saw in 2018-19. So there's some distance to go with that. On the positive, these very good results we've delivered are without that market uplift, if you like. So to the extent that any of these subsets, which they could, trade more strongly than is currently forecast, then that is opportunity for us within BP. Thanks, Martin. In terms of the business performance for the group's businesses delivered 14% increase in revenues year on year, which is very good, which delivered a 56% increment in profits. And you can see from the way the margins have gone from 9 to 12.3%, that incremental revenue drop through into profit is quite strong. And if you do the maths, it's a 36% margin on the incremental revenue, which is significantly ahead of the total operating margin. So this, if you like, betrays the fact that within our business, like all rental businesses, there is an element of fixed cost and revenue opportunity within the fleet, which if we can capture that revenue, then we can get strong translation into profitability. So it was a much improved result despite some markets not yet being back to pre-COVID levels, as I discussed in the previous slide. The UK division, which is the largest part of the group, and also reminding everybody this includes Groundforce Europe and TPA Europe within the definition of UK. This is a major contributor to the group numbers. I've talked about the markets in along the bottom. More specifically, infrastructure, HS2 and transmission being strong was very positive for the likes of our TPA business, for our Groundforce business. However, by contrast, a weaker AMP7 impacts Groundforce, and a weaker CP6, that's the rail industry, does impact our Torrent Trackside and other businesses across the group that support rail. The construction market was busy in RMI, which was positive for Brandon Hire Station and MEP in particular, but new build was quieter, again affecting the likes of Brandon and affecting Groundforce in terms of their activity levels. House building's consistent, so that was good for UK Forks, where house building's their core component. They continue to do well with strong relationships with major and regional house builders. There were some supply chain constraints for UK Forks during the year. It's the lead times on new telehandlers, which is what UK Forks operate, is still very long, and that to a degree has subdued their ability to grow even more. And I made the point on the previous slide about the group that the margin improvement from 9.7 to 13.1 illustrates the positive impact of operational gearing when your revenues are on the up. Our international division made a reasonable recovery in the year. Profits are up a lot, but that was from a low number, and margins are still a lot lower than the rest of the group. But in fairness to those regions, the lockdown and and opening up from lockdown in the regions we operate internationally was much slower than it was in UK and Europe. And in particular, Australia, New Zealand and Asia markets did lag the UK and European markets in that scenario. We're now seeing, with a freer and a more open market, we're seeing activity start to pick up in both those businesses that form the international division. Within AirPac, border openings do impact that business, as I've mentioned before, because we have to move engineers, as do our customers, have to move people and materials between borders, which is pretty difficult when closed. So still plenty to do there. I'm sure we'll continue to see good progress from the international business recovery. Their markets are arguably 3 to 6 months behind ours. Just moving on to investment, making sure that our fleet is fit for purpose in terms of its quality and the demand from customers has always been a core part of what we do. We did have a strong CapEx investment in the 12 months, up from 40 to 60 million. And that's a mix of growth CapEx for those businesses who are now trading ahead of pre-COVID levels, and also some preemptive investment where we've had to buy earlier and in bulk to try to minimise the potential future impact of lack of supply or slowness in supply. So there is an element of both of those within that 60 million figure. What that new investment has allowed us to do, however important, is that we've been able to have a strong emphasis on eco-friendly product substitution. Many products which historically have been diesel and petrol powered have been replaced with battery equivalents or solar powered equivalents, and that has worked well for our customers with whom we're engaged on that process. And obviously we've been working closely with manufacturers to deliver solutions that are reliable, cost effective, and helping our customer base to minimise their emissions. Final point is capital commitments are a bit higher than they would normally be at 14.5 million, but that again is part and parcel of the making sure that we reduce, minimise our supply chain issues. So those capital commitments are being made a lot earlier than they would historically have done. On ESG, I reported last time that there was the group had committed to Science-Based Targets initiative, and this does underpin our plan for the group. The short-term roadmap that we have has been adopted. It's actually an appendix to these slides and is being delivered on. The investment in new rental fleet, as I talked to on the CapEx slide, has focused on green equipment solutions, which include, amongst many others, solar panel lighting fleet, development of charge pods, wide and increasing range of battery-powered tools across a lot of our businesses, and also a growing fleet of electric compressors, telehandlers, and mini excavators. We estimate that about 71% of our rental fleet is actually zero emission at point of use, which is quite a large proportion of our fleet, much of which has not got an engine or power requirement. But that gives us a measure, if you like, of how we can try and increase that percentage as we reduce reduce the emissions associated with our hire fleet. More internally facing, but we've done a lot of work on vehicle and property emission reduction. We are sourcing lower emission commercial vehicle replacements. The company car fleets transition to sustainable vehicles. We've got renewable electricity supply in all our UK locations. We're starting to introduce solar panel installations to certain of our depots, and 96% of our waste is now diverted away from landfill. In terms of biodiversity, we've also committed to 7 separate UK conservation projects during the year, and those come along with good colleague engagement opportunities to be involved in those important conservation projects. And my final bullet is really to remind everybody that in rental, it's the concept of a shared resource, and in our view, that makes us a fundamentally eco-friendly option in terms of reducing emissions. So my last slide before I hand on to Alison, in terms of outlook, we're continuing to deliver market-leading quality of earnings, whether measured by return on capital or by margin. The new financial year has started well and in line with our plans and expectations. We've seen an encouraging pickup in AMP7 and CP6 activity into the new financial year, which bodes well. And HS2 does remain a good long-term opportunity for us. Residential construction is stable and robust, and whilst there are supply chain delays and inflationary pressures, we have been able to match many of those increased costs by improving higher rates, and rental pricing has improved, and we're also continuing to deliver on cost efficiencies where we can. Recruitment of people, it's a tough market in terms of recruitment, and I think that will be that way for some time to come. So we've had a big focus on not only just the terms of what we have to offer to recruit and retain in terms of monetary and package, but also in terms of investing in learning and development. And we've had a refreshment of our learning and development programme to enable colleagues to progress their careers, hopefully within BP, and that is now well underway. In terms of digital, there's been a good progress on that during the year with a number of new developments across the divisions. Brandon Hire Station did launch their new web app in January, and we're starting to get some good traction on that alongside the new website. And Ground Force have also continued to develop their Your Solutions website, app which allows the customers to make a preliminary design for their shoring requirements. And again, it's now in its third version, and we're offering increasingly levels of complexity in terms of what customers can do, and we see that as a good source of growth also. I've done a slide on ESG. We have got excellent momentum in environmental and in delivering sustainable solutions to customers. We won't be talking about this today, other than I think it would be remiss to not remind everybody that there is a formal sales process underway, which was announced in April. But perhaps more importantly to shareholders, there is a strong commitment from myself, from Alison, from the rest of the team, that this is business as usual. We're continuing to concentrate on delivering our plans for the next 12, 24 months, regardless of that process, and not just being distracted. And I think that is being embraced right the way through the business. So we're well positioned to make further good progress. There are opportunities there, although we will also at the same time have to manage through the inevitable challenges of the current marketplace. So that's all I'd like to say. I'll now hand over to Alison, who will talk you through financials.
Thank you, Neil, and morning, everybody. So my first slide, a financial highlights slide, really just to re-emphasise the points that Neil's already made, that we have delivered a good set of results showing strong recovery from COVID. So we have the 14% increase in revenues and 56% increase in profit. And pleasingly that we continue to have strong cash generation. So our EBITDA was up to 88.9 million. Moving on to my next slide is around earnings per share and dividends. So we're proposing a final dividend of 25.5 pence this year, and that would make a full year dividend of 36p. This reflects the thing that we trailed at the interim results, which was a rebasing towards 2 times cover and a more balanced interim final split. There is a large uplift year on year, but that reflects the fact that we didn't pay an interim dividend in 2021 due to the uncertainty caused by COVID. My next couple of slides are showing a longer term view of our dividends over the past 10 years, and that shows that we've implemented a progressive dividend policy which reflects growth in profitability, and so we have that growing trend except for the interruption caused by COVID, which was reflected in Neil's earlier slides. Return on capital employed is a key measure for us, and I'm pleased to report that this is in line with the long-term target now. So prior to COVID, we were at 14.5%. We aim to have 15% target throughout the cycle. We dipped down to 9.2 because of COVID. And at the interims, I said that we expected to be back up, and we're at 14.5%, which is well ahead of our weighted average cost of capital, which is estimated to be 8%. We have a strong balance sheet, and this has been further strengthened in the year. The key points I'd point to is the fleet, hire fleet. We have 217 million of hire fleet on there, which has grown by 10.6 million in the year. Working capital was impacted by COVID, so we benefited in 21 by an inflow of working capital as our debtor book reduced. Inevitably, there's been a reversal of that in the financial year 2022, which you can see in the balance sheet there. Net debt increased by 8.7 million in the year. I've got a cash flow slide yet, and so it grew to 136.6 million. I'm also pleased to report that debtor days are a day down at good levels of 55 days, and bad debt write-off as a percentage of revenue is at 0.6, which is consistent with what it has been in the past few years. We will continue to monitor debts as people recover out of COVID. We generate strong cash flows, which I've mentioned before. I've also mentioned that EBITDA increased to 88.9 million. Neil's mentioned that we did invest strongly in CapEx, so you can see total CapEx was 68.7 million in the year, which is an uplift of 22 million year on year. We also made a small acquisition of M&S for 2.7 million cash during the year, and as a result of that, as I've already mentioned, net debt moved by 8.7 million, which we feel is a modest uplift year on year. My final 2 slides are on net debt and facilities. So we did refinance during the year. We had a 135 million revolving credit facility that was due to expire. So we replaced that with a 90 million revolving credit facility, which includes a 20 million accordion, which is an uncommitted facility within there under the same terms and conditions. We had a private placement of 65 million already in place with Pracoa, but that included a shelf, which we took advantage of and drew down a further 28 million. And the consequence of the refinancing is that now we have 51% of our facilities as fixed rate borrowing, the private placement, and this has a further 5 to 6 years to go before they mature. At the year end, because our net debt was 130.6 million, we had almost 60 million of headroom against our facilities, which we feel leaves us well placed to grow the business going forward. And then my final slide is on our covenants. We have robust headroom against our covenants. There are 2 in our documents. One is net debt to EBITDA, which has to be less than 2.5 times. And at the year end, it was 1.43 times, so well below that. And then the other covenant is EBITDA interest cover has to be greater than 3 times. And you can see that at the year end, it was 10.12 times. So we have plenty of headroom there.
Thank you both for that helpful presentation. As a reminder, people can use the Q&A function at the bottom to submit their questions. But we've got a couple here to get started. Can you talk a little bit about higher rates and your ability to push them up in the current climate?
Yeah. So I think the current market situation in terms of being able to address higher rates is different to what I've seen in many years. there is definitely a greater level of acceptance than we've seen for a long time that higher rate increases are required, and higher rates are being increased right across our business units, from low to high single-digit increases. I've mentioned, I think, at the interims that some of our customers operate on longer-term agreements, say for 12 months, and so we address those increases at the anniversary, and pleasingly, we've had a lot of success at the anniversaries to increase rates. And given that there is inflation within the cost of the capital that we're buying, it's imperative that we are passing on some of that increased cost by way of higher rate improvement. The purchase of a fleet item to rent at a slightly increased cost, i.e. with a price increase, is a bit different to if we were buying that product to sell it on the following day. We don't have to capture all of the margin that's lost, if that's the right way, straight away, because we've got the entire lifespan of that product to recover that incremental cost. So the impact of, and we have seen, whilst we've seen some modest fleet investment inflation, we've seen some quite high percentages as well. And frankly, in the current supply chain scenario, we haven't got a lot of negotiating power on that. So, but we are able to spread the financial cost of CapEx further. But there are more pressing ones, such as in transport costs. Fuel costs have gone up, transport costs are going up. These are costs that we have to mitigate now. We can't spread those over time. And so again, that's another, makes it imperative that we are able to pass on those costs by way of price increases in the market. Some of our markets are in a situation where there is a shortage of product. And again, that helps the conversation in that when there is you've got demand outstripping supply, that again reinforces our ability to put prices up.
Okay, thank you. How will the strong dollar impact your business and profitability?
Of itself, it shouldn't. It may impact the wider economy, but it's not. Our dollar exposure is only through our Airpac Buchan business, which is low single-digit percentage of the group's revenues.
And so much of that is Australian dollars as well.
Yeah. So we've got limited exposure to the US dollar in terms of a direct consequence. Whether the strength of the US dollar has an impact to the wider economy, then obviously time will tell. We don't acquire much product from the US, so we don't buy much in US dollars, and we do a little bit of trade in US dollars. It's not a major impact for us.
Thank you. Acquisitions. Obviously, you've got a strong history of doing beneficial bolt-on acquisitions. Is the current situation with the sale process putting a hold on them, or what you've seen in terms of opportunity out there in the wider market?
Yeah, well, I think that the position is going to change in terms of the market, the M&A market. I think that I said last year that I didn't think that vendors would necessarily put their businesses on the market in 2021, and probably it will be later into 2022 before we saw that happen. I think opportunities will come forward in 2022. Our focus has always been to do a mix of organic and acquisition growth, and I see no difference 2022, 2023, that we will continue to do that. So as the opportunities come forward, and if they are relevant, then we will pursue them. And so there is no artificial hold on that whilst there is the FSP on at the moment. It just, but up to now, the opportunities coming forward have been relatively small. I think that will change. So I think it is for us, and concentrating on business as usual, I think that will continue to be an important feature for VP.
Okay, thank you. Well, then perhaps this next question feeds into a little bit as well. What are the main risks to your business in the next 2 years? Are you looking at a potential recession in the UK?
You, me. Well, I think that as of yet, we've seen business activity continue to recover or stay relatively stable. So we've not seen any short-term impact to some of the challenges that are out there at the moment. Is that likely to change? Possibly. We're not forecasting that to change at the moment. I think it's quite important to emphasise the quality of the results was built around RMI, infrastructure and house building. And our current view is that those key markets will continue to progress despite or in spite of some of the challenges and headwinds around the economy. There is a lot of uncertainty out there for everybody, but we're not seeing that translate into to the detriment of business trading at the moment. The bit that's more likely to be impacted by what you mentioned is back to my market slide, is the bottom left-hand quadrant, which is actually a market area that we have not been as busy as we might have been anyway. So it's not like we're going to lose anything if that's the quadrant. That would be the favourite quadrant to be affected, if you like, from our business point of view. Hopefully not. As I say, in the short term, we've not seen anything that we would describe as detrimental. Some of the markets are more flat than we might have hoped for, but nothing's going south.
And then we have the non-UK revenues as well, which is a bit of mitigation.
Yeah, so in European revenues continue to grow, which is great. And our international division, we see good progress for both of those businesses, and that, although international looks relatively small, that's part of the rationale to have international and European businesses, is to mitigate more localized pressure in the UK.
Okay, perhaps then feeding on a bit more here on supplier chain challenges. Obviously, within the UK, how are you seeing other competitors affected? Are you all suffering equally, or do you see opportunities for you to benefit off others' weaknesses?
I think the short answer to that is no. I think everybody's in the same boat at the moment. I think that supply chains are still extended, whether it be for vehicles, for plant and equipment, tools, spares, and I think it's a common challenge. And I don't think there is obviously I'm sure we would all say we've got the best relationships with supply chain, etc. But in truth, I think it's the severity of some of the backlogs and the reasons for it are universal. And obviously we do everything we can to mitigate the impact of that. Do I see it as giving us an edge over competitors at this very point in time? No, unfortunately, I don't.
Okay, well, thank you both for your time. That's it from questions. So good luck, and we look forward to hearing from you again in 6 months' time.
Thanks very much.
Thanks, Anna.
Thanks, Anna. Bye-bye.
Bye-bye.